Thanks for inviting me to speak today. I'm happy to be here, and I've learned so much already from the first two sessions. And I think you've already sort of gotten some little teasers of the session that I'm going to do today, so I hope that this will leave you even more perplexed at the end of this 30 minutes with me. So just a little bit about the CAS and what I'm going to talk about today. So for those of you who don't know, the Casualty Actuarial Society is one of the credentialing bodies for actuaries, both in the U.S. and around the world. We focus exclusively on property and casualty risk management and insurance. And we provide, in addition to the actuarial exams that many of us take, we provide continuing education, we commission research to support actuarial practice and insurance industry practice, and support our members through their career journeys as well. And one of the big privileges that I've had in my role is to manage our CAS approach to race and insurance pricing and the production of our research paper series on bias in insurance. This is now 11 papers and going strong. We've got a few more in the pipeline right now. And they cover a range of sort of starting with foundational concepts, getting us all on the same page of why are we even talking about bias and fairness in insurance, what is happening now in regulations, where do we see that going in the future, and some of these things like fairness testing solutions that are being built. And they're really intended for audiences of all backgrounds and levels. So if you're interested, they're all free on the CAS website. I've got the QR code there, but you can also go to casac.org/bias and insurance research. And I'm going to talk about one of the earlier papers today. Let's see if this works. All right, I'll do it that way. One of our earlier papers called Defining Discrimination in Insurance. And one of the things that my main takeaway, I'd say, from being able to observe a lot of the insurance industry discussion around bias and fairness in insurance, and also from reading this paper, is that the words that we use really do matter, and they can kind of make or break a discussion around fairness within our industry. Are we talking about bias? Even bias on its own is a really hard word to define, and it's hard to get agreement on what we mean. You know, we've got statistical bias like sampling bias. We've got cognitive biases like confirmation bias, stereotyping, and societal biases, discriminatory rules and norms and practices. All of those different things can kind of overlap a little bit, or they can be completely different, and it's hard for us to agree on what we're talking about when we talk about bias, or even, understanding or parsing out what types of bias are relevant here. And then you have discrimination, and you have all of these sort of related terms about discrimination that we're all using, sometimes interchangeably or sometimes to mean different things. We've got disparate impact, disproportionate impact, proxy discrimination, which is a big one I'll talk about, and unfair discrimination, which is really an insurance context. So we need to sort of get on the same page, and that's hopefully what this session will help us to move towards. And this is just going to echo what Faye said, really. We have to decide what is fair if we want to evaluate whether something is fair. What does that mean? It really depends on who you're asking, what type of fairness that you want to achieve. And different parties have different views on that. And I heard Faye say in the earlier session, we need this multidisciplinary approach to problem solving, but that also brings challenges with all of our different disciplines maybe believing different versions of what might be fair or having different fairness goals. So I'm going to go over 4 sort of different sections here. The first is looking at protected class or protected status and sort of some of the implications there, what that how that's evolved over time. We're going to look at unfair discrimination, how that developed in the insurance industry and what that means for us in this conversation, proxy discrimination and some of the challenges in defining that term, and then disparate impact. So when we're talking about fairness, often we're first trying to decide who are we worried about or who do we want to protect from discrimination? Who are we concerned that harm is happening to? And usually then we're thinking about some of these protected classes. So just a quick definition, a protected class is a group of people who share a common characteristic for whom federal and state laws have created protections that prohibit against discrimination because of that trait. And what I'm showing here is U.S. specific. It may be similar in other jurisdictions like Australia. It may be very different in other jurisdictions like France. So we can't just use this same sort of understanding of protected class everywhere that we go. And our notion of what should be protected, what is protected legally, has evolved significantly over time. So we talk a lot about race. Race actually was first sort of included as a protected class in, I believe, 1866. But again, in 1964 in the Civil Rights Act, along with religion, national origin, and sex, were deemed as protected statuses. And then we added on family status and age in two different acts later in the 60s. We added on to that veteran status and disability in the 70s, and disability actually even that it evolved over time from being protected just within the government to more broadly in across employment law. And then what counts as a disability? Like that has changed over the years since it first became protected in the 70s. More recently, genetic data became a protected status. And then in 2020, there was a Supreme Court case that ruled that discrimination on the basis of sexual orientation and gender identity basically counts as discrimination on the basis of sex. So those two became protected as well. And this can continue to evolve, right? We've seen some sort of challenges to that recent 2020 court case, and we may see more sort of parts of our identity that become protected over time. So this is not static. So when we're talking about fairness, we're going to need to keep revisiting this to understand who are we trying to protect, why, and how do we determine that. A couple of other caveats here when we talk about protected class. For the most part, a lot of these laws have applied to employment, some to housing. In insurance, we sort of have a different system, which I'll talk about. And not everything here is protected across the board, across states and insurance. So sex and age, which I sort of coded in blue there, are two examples where we do regularly use that information for insurance rating. Not every state, but many states. So it's not necessarily protected in an insurance context. So that matters as well. And one other thing I'll note I don't have on the slide is that these are all sort of different parts of our identity. Some of them might be like on your birth certificate. Some of them are things only you can know. So it is really hard to figure out if some sort of discrimination is happening when we're not necessarily sharing this information or giving this information to our insurance companies, for example. So we do end up having to do sort of different approaches like Faye mentioned, BIFSG, to sort of estimate that information, or we have to ask people what their identity is. And discrimination can also happen just on the basis of what somebody perceives your identity to be, whether or not that's true. So it's very complex just how we even understand what is protected. I should also have mentioned earlier, I am an actuary, not a lawyer, not a legal scholar. There are other people in the room who are, so I welcome your corrections or additional context elaboration at the end of this session. All right, so I mentioned that insurance we're a little bit of a different animal when it comes to these protections. And that goes all the way back to 1945, the McCarran-Ferguson Act, which when adopted brought us two different concepts that are really important in insurance right now. Reverse preemption, which essentially means that state-based insurance regulation takes priority over federal insurance regulations and laws. So we prioritize states when there is a federal law that's not specific to insurance, when there is a state law that is or pertains to insurance, and if those two conflict, then states take priority. So for the most part, states regulate insurance in the United States. And so then we want to talk about discrimination, right? And one of the things that comes up here is, can discrimination be fair? We have this concept of unfair discrimination, or the statement, rates must not be excessive, inadequate, or unfairly discriminatory. So if you can't be unfairly discriminatory, that sort of implies that there is a such thing as being fairly discriminatory, right? And for most consumers outside of insurance, that's kind of like an oxymoron, like that can't exist. And somebody said this morning, we all agree discrimination is bad, but we don't, in insurance, necessarily agree that discrimination is bad in this context. So the use of unfairly discriminatory, maybe it's sort of an unfortunate choice of words, and that really what we're saying is we want to fairly differentiate between risks, right? So we're trying to match prices to expected cost. If somebody brings more risk to share in the company, they should pay a little bit more. Somebody else who brings less risk should pay a little bit less. So we're trying to discriminate between those two sort of different levels of risk, and a lot of consumers, I think, would feel that actually is fair. So it is possible to fairly discriminate in this context. And it's important, again, to note that we talked about protected class, and those protected sort of statuses that came from the 60s all the way into now 2020. This came before that in a way. So many state insurance statutes or unfair discrimination statutes don't really mention protected class. Unfair discrimination and protected class status are sort of separate things, and they may or may not be incorporated at the state level into their laws. That doesn't mean that we're discriminating unfairly on the basis of race in one state and not in another, but just that it's not necessarily codified in exactly the same way across all of our states and jurisdictions. So a little bit more history. I feel like in this insurance industry debate, sometimes it can feel like we're just now really focusing a lot on race, and we're talking about fairness a lot. But it's helpful to see that really this has been a debate or an ongoing discussion for many, many decades. And what I'm showing up on the screen is just about the last 80 years or so, and some milestones where we've focused a lot on race or had a lot of questions about race in the insurance industry, and how it's sort of, again, our concerns about fairness have evolved or varied over the course of just this past 80 years, right? So this is helpful context for us. Back in 1947, the Unfair Trade Practices Act, adopted by the National Association of Insurance Commissioners, this was the first time that it was prohibited to refuse to insure or to cancel somebody's insurance or non-renew on the basis of race, right? So that was sort of explicit discrimination. We were allowed to do that until the 1940s. But it wasn't until almost 20 years later that they said you can't charge different life insurance premiums between different by race, right? So it took a little bit longer for us to sort of think that, okay, now this is protected for this context. And I'll skip ahead a little bit to 2000 because it's related, this NAIC life insurance resolution. So I said that was prohibited to charge different rates by race in the 60s, but even in the year 2000, there was a lawsuit alleging that while the insurance companies stopped selling those policies that were different by race, they still kept the old ones on the books. So it's a kind of good lesson for us that even if you make something illegal or prohibited, that definitely doesn't necessarily reverse the effects of what already happened. And it may not even mean that that practice has fully stopped or in the way that we expected it to. So stepping back a little bit, in the 70s, the NAIC had a redlining task force, so they were looking into what might be happening that could be called redlining in the insurance industry. And an example in that situation was like insurance companies canceling or closing their insurance agencies in minority communities. So essentially making it harder for those communities to buy insurance, or maybe it's not available at all. And then in 1992, this was around the time of the LA riots, the beating of Rodney King. After that, the NAIC, again, sort of looking at availability and affordability of insurance, in particular for minority communities. So this isn't necessarily about discrimination, but about some of the impacts of the regular practices that we have, right? And maybe some of the lasting effects of what's happened in the United States. And that kind of echoes what happened in 2020 with the murder of George Floyd, and all of our industries in the U.S. are taking another look at whether or not there was discrimination happening, affordability, availability of insurance. We're kind of in another phase of that now. But even right before 2020, right before that sort of catalyst, the U.S. House of Representatives introduced 2 proxy discrimination acts for consideration. One prohibiting auto insurance discrimination, and another related to use of credit score in insurance. So we've just been talking about this for a long time. And I think we will continue because these issues keep recurring. So what I sort of hinted at and what you may have picked up is what mattered to us with regards to fairness and discrimination, even across that timeline, kind of changed or shifted and morphed, right? So in that earlier part of the timeline, the 40s and the 60s, we were really thinking about disparate treatment a little bit more, the intentional treatment of protected classes less favorably because of that protected trait. So we were canceling policies or charging differently based on race, and we didn't want to do that anymore. But then after that, we started thinking more about disproportionate impact. So when those practices became illegal, we started worrying about, well, are we still seeing disparities between different communities, whether it's by rates or access to insurance, etc. And we have here a definition from the American Academy of Actuaries specific to insurance rates. It's when a rating tool results in higher or lower rates on average for a protected class after controlling for other distributional differences. But when you see that disproportionate impact happening, it's kind of natural to try to understand why. So often that then begs questions around whether or not proxy discrimination is happening. And I'm going to go a little bit more in depth on proxy discrimination, but broadly, and Dan already kind of defined it for us, the use of a seemingly neutral criteria which acts in whole or in part as a statistical proxy for a protected trait. So in other words, there's some correlation between this factor that we're using and a protected trait like race. Redlining is an example of proxy discrimination. This was part of the how you got a mortgage back in the 30s and 40s. And basically we were categorizing different areas by color: green, yellow, blue, and red. And those color classifications were based on property, information about the location, and information about the borrower. So on its face, it doesn't necessarily look like location is a proxy, but often we found that this location was related to the racial makeup of that area. And there were even notes in the Homeowners Loan Corporation underwriting manuals about racially inharmonious groups, or if the racial makeup is changing in this area, that's going to create instability and increase mortgage rates. So while it appeared sort of neutral on the surface, there was really some underlying information about race there, and that caused major challenges, especially for African Americans, to get home loans. And redlining was just one of the many practices that we did in the United States that sort of really had long-lasting effects, especially on segregation and other economic sort of indicators. We had explicit segregation, we had redlining, which I mentioned, racially restrictive covenants, meaning it was in the deed that you could only sell this house to people of a certain race, race-neutral methods like requiring that in this area you can only build homes of a certain lot size, so you can only build larger homes that sort of priced out communities, lower income communities. And in 1968 with the Fair Housing Act, all of that was sort of intended to be stopped. But like I said, when something becomes illegal or prohibited, that doesn't necessarily mean all of the impacts are reversed. And we still see long-lasting effects of those segregation policies and practices to this day. In particular, we see correlations between race, location, home ownership, and credit scores, which we've mentioned a few times, to race as a result of this really long and sticky history of segregation. And those factors that I mentioned, homeownership, credit score, location, they're really commonly used in insurance. So it is reasonable, I think, for us as an industry to ask this question, is there potentially proxy discrimination happening? So proxy discrimination, maybe that's the natural next question, but there's a lot of challenges in coming to agreement on what this term means. Challenges in how we define it, how we identify it, and how it's dealt with. So yeah, I've got these sort of three nodes here that make it hard for us to use this term effectively when we're talking about identifying discrimination or fairness. So the first challenge is intent. Essentially, did we mean to discriminate or not with the use of this spatially neutral factor or information? And some parties in the industry and some stakeholders say it has to be attached to intent. If you didn't mean to discriminate with the use of this factor, then it's not proxy discrimination. And back in the time of that Homeowners Loan Corporation manuals, you could actually look in the manual and say, hey, look, they mentioned race here. That's intentional, that's proxy discrimination. But nowadays, it's like, are we looking for an email or what? Where are we finding this proof? And that's going to be pretty hard to do. And I would argue most of the time insurance companies are not using a factor with intent to discriminate. So maybe that's not even the issue. But regardless of that, what even is a proxy? Right? That's actually pretty hard to define. We've got, correlation is the first thing that comes to mind. Does something need to be 100% correlated to be a proxy? What if it's 51% correlated, 52? Like, where is that threshold? What if multiple factors are correlated with race? Are they all considered proxies? What if race is correlated with age in your data? And as a result, younger drivers get charged more, and so you see sort of this impact on this racial group. How does that come into play? So there's all these different questions around just even how you define a proxy. And then enforceability. Once you deem that something is proxy discrimination, what do? Do you just take that factor out? Do you try to control for race somehow in your model? There are a lot of different questions around that as well. So it's not that easy to just say, well, we're looking for proxy discrimination. You have to answer a lot of these questions to get on the same page. And I only have a few minutes, so let's see. This is an example I'll go through quickly. In 2007, the Federal Trade Commission tried to do this exercise with credit-based insurance score. Basically, they asked, is credit-based insurance score a proxy for race or ethnicity? And they did 3 different tests to try and make this determination. One, they just looked at within individual race groups, does credit-based insurance score help us to differentiate between higher and lower risks? And they found that yes, it does, right? So it's effective even within those groups. Maybe it's not a proxy. That sort of leans towards not a proxy. They also looked at, does incorporating credit-based insurance score into the model increase the predicted risks for different protected classes? And they found that using that factor increased the risk, predicted risk for black drivers by about 10%, and for Hispanic drivers by about 4%, and it decreased the predictions for white and Asian drivers. So that sort of suggests maybe it is a proxy. But then they looked at the third test. They added race into the model and tried to sort of suck out the effects of race and see what was left. In theory, if it is a proxy for race, then credit-based insurance score really doesn't have much power or effect once you add race into the model. And what they found was it did sort of take away some of that effect of credit-based insurance score, but not by much. So it went from, for black drivers, 10% increased risk to 9% increased risk. And for Hispanic drivers, 4 to, I think, 3.5. So it didn't really, putting race in and kind of drawing that effect out did not really make that big of a difference. So maybe it's not a proxy, right? So the FTC just concluded, no, CBS is not a proxy, even though its use does have a disproportionate impact on these groups. And that's just one approach. You know, we could come up with a lot of different ways of saying this is a proxy and testing for it. And the last term that I'll talk about here is disparate impact. So I think with proxy discrimination being such a fuzzy and debatable term, sometimes we want to just like head in a different direction. And I hear a lot of people saying disparate impact, and often kind of meaning the same thing as disproportionate impact or just disparities in general. But many of us in insurance, those of us who aren't lawyers, probably don't know that this is its own specific legal framework. Most often, I think, applied in housing, maybe employment, not applied yet in insurance. And potentially, you know, there have been questions around whether or not it should even be applied in the context in which it is applied. But for now, it kind of gives us a little bit of a framework that we can use. So this legal framework is a 3-step process. First is, will the practice cause a discriminatory effect on a protected class? And it's up to the plaintiff to prove this. If they can prove that, then the next step is, now it's the defendant's turn to show that there is a necessary relationship to a legitimate business interest. So they're saying we need to do this because it achieves this business goal, which all of us agree is something that we want to do, right? If they can prove that, if they can't prove that, they need to stop doing it, right? Because they're causing a discriminatory effect and they don't need to. But if they can, then we go on to the third step, which is, could the interest be served by an alternate, less discriminatory practice? The plaintiff has to prove that. And if they can, then disparate impact is found. If it can't be served by an alternate interest, then there is no disparate impact. So we're not applying this in the insurance context, and I'm not saying that we should, but I think we'll see probably some flavors of this in some of the testing regulations that come out, some of our own thoughts about how do we define fairness. This maybe just serves as another source of inspiration. So this is my last slide. Why should everyone care? We all need to get on the same page. We talked a lot about consumers not understanding what is happening to them. If we can't even agree amongst the stakeholders of what we think is fair or unfair and what we should do about it, then inevitably the consumers aren't going to be able to understand either. So if we can sort of come to some consensus around what we're trying to do and be able to explain that to ourselves and outwardly to our consumers, then we should be able to come to a more optimal solution and, of course, bring all of our stakeholders, including consumers, to a better place, better informed. So that's it for me. I'm going to pass it on to David next. Thank you.